part 1 of this series. You have learned about what should be your first 5 steps when you are entering in stock market. In this video, we discuss what be your next 5 steps in your stock market journey. 6th step is tax duties. All tax duties are defined under Customs Act 1962. Following are the tax duties which you need to pay in export-import business are: Basic Custom Duty (BCD), Additional Custom Duty, Social Welfare Surcharge, IGST Levy, Additional CVD, Compensation Cess, Protective Duty, Anti-Dumping Duty, and Safeguard Duty. Seventh step is pre- and post-shipping documents. There are certain documents required for shipping your goods. Without these documents, you will not be able to send or receive your goods to or from the destinations. These documents are: Invoice and Proforma Invoice. Means it will show the cost of goods. Packing List. Means it will show the list of all the goods and their quantity. Intimation for Inspection. Means this document shows that if someone wants, he can inspect the goods. Certificate of Inspection. Means this shows that your goods have been inspected. Insurance Declaration. Means this document shows you have taken insurance. Certificate of Insurance. Means you should have certificate of insurance, so that in case of any damage, it is clear that who will be liable for the loss. Shipping Order. Means you should also have a shipping order. Other documents are needed. That besides above, there are many other documents required. These are: Application for Certificate of Origin, No Commission Certificate, Bills of Exchange, Shipment Advice, Ladder to Bank for Collection, Insurance Premium Certificate, Shipping Bill, Vehicle Ticket, and Receipt for Port Charges. Eighth step is import product. Following are the products that are imported the most is: electrical machinery, mobile or cell phones, screen guards, heavy machinery, fancy lights, plastic toys, edible oil, footwear, bags, iron and steel items, fertilizer, food items, and frozen items. Is risk management and insurance. Export-import business involves various risks like: political risk. Means it occurs due to the changes in political situations, like in case of war between two countries. Legal risk. Means, for example, if a company says that you have copied their products, then you will face some legal problems. This is a type of legal risk. Transportation risk. Means this type of risk occurs while transporting goods, like the ship sinks or your plane taking products has crashed. Poor quality risk. Means if the product is not as good as the sample sent by you, then there is risk of cancellation of order by your client. This is poor quality risk. Credit risk. Means when you have exported goods to the buyer, but he is not giving you payment. It is a credit risk. For example, you have signed a contract when the rate of dollar was 78 rupees. And the buyer has agreed to pay you $11,000. Now when the payment is made to you, the rate of dollar is reduced to 75 rupees. In this case you will face loss due to currency fluctuation. All these risks can be managed through the following ways. These are: EFC, Exchange Earners Foreign Currency Account, This account can be opened in the bank, wherein you have your savings account. In this account, your money will remain in foreign currency, and you can convert it into your domestic currency whenever you want. Booking forward contract with bank. It is a contract between bank and customer to convert currency at a future date, which is decided in advance. In this, you have to be prepared for both the situation, as in the exchange rate may increase or it can decrease. Insurance. It saves you from the risks associated with natural calamities. Insurance will give you following benefits. These are: protects from financial losses, saves you from spoilage or damage of goods, and helps to meet contractual obligations. Types of insurance. Ship insurance. This insurance is done by the owner, so that if his ship sinks, then he can recover the loss of goods and ship both. Cargo. In this type, the insurance of goods is done. Freight. If any damage happens to goods in transit, then this insurance is beneficial. Liability. If collision occurs between two ships, then liability insurance will save you. Voyage. This insurance is for destination to destination. For example, if your goods are reaching from the USA to India, then this insurance will be applicable for this particular destination only. Fleet. This insurance is for container or vessels. Single vessel. This insurance is only for a single or individual vessel. Port. This insurance saves you from damages like fire at the port, earthquake, tsunami, etc. that can happen when your goods are at a port. Tenth step is government incentives. Export-import business brings foreign currency, and thus, it is beneficial for the country as well. Government promotes export so that you, government, and country, all three can benefit from this business. There are many government schemes which provide you incentives for doing export-import business. These are SEIS, Service Export from India Scheme. This scheme promotes service export and gives facility of duty drawback, which means you get the refund of the excise duty. EPCG, Export Promotion Capital Goods. This scheme was introduced so that Indian manufacturers can import capital goods such as machinery and can produce quality products. AA, Advance Authorization. It gives import of raw material